fake money, fake teachers, fake assets. In 1971, President Richard Nixon took the U.S. dollar off the gold standard, turning the U.S. dollar into fiat money, government money, fake money. In 2008, the world economy crashed when fake assets, fake mortgages, and fake financial experts led us down a path to ruin. Think about this. Why do schools choose not to teach us about money? Why are 78% of all Americans living paycheck to paycheck? Why are students staggering under $1 trillion in student loan debt? Because a fake world makes the rich richer and the poor and middle class poorer, and that's exactly how the government wants it. The only way to protect yourself is to learn how to separate the real from the fake. Go to richdad.com to get your copy of Fake by Robert Kiyosaki and learn how to spot the manipulation of reality we live with every day. Don't get fooled again. Get your copy of Fake by Robert Kiyosaki at richdad.com. That's richdad.com.
This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. It's Robert Kiyosaki of the Rich Dad Radio Show, the good news and bad news about money. Today we have a very, very important show, and it is on a very important subject. And it's a subject that's near and dear to my heart. It's about brothels. No, I mean risk. Risk. No, it's that word is a four-letter word, yet I know the word risk holds so many people back in their lives. And as a person who spends most of my time talking to people about money and things like this, I notice that most people are so terrified of losing money or making a mistake or what if my business fails? And it goes to this subject called risk. And it is not just a superficial surface four-letter word. It goes deep down into the core of the individual. So risk means different things to different people. So today our guest is Allison Schrager, and she's the author of a book that sounds interesting. I haven't read it, but I'd like to read it. It's called An Economist Walks Into a Brothel, which came out 2019 this year. And I really like the title already, and she's going to be talking about people who walk into brothels and also surfers. So as some of you may know, I grew up in Hawaii as a surfer, and I must admit I have walked into a number of brothels in my lifetime, and just to take some risk. So my wife is here, Kim, so she can tell you that I actually called her from a brothel once. Any comments, Kim?
Well, you did actually call me from a brothel. Yeah, I think you were in Costa Rica, and you said, "Kim, I'm in a brothel," and I'm like, "Well, tell me what it's like. I've never been in one."
Yeah, but it was really a nice, interesting
huh?
people.
But I'm very excited to talk to Allison because she's all about risk management, and it's something we haven't really talked a lot about here. But if you think about it, in your business, there's risk management. In finance and money, there's risk management. In every day of your life, there's risk management.
Crossing the street looking the wrong way is risky.
Health, sports, everything is risk management. So Allison is the expert, and she's studied it from, as Robert says, she studied it from brothels to surfers and all sorts throughout the globe. So I'm anxious to hear her take on risk management and how to manage it, but more importantly, how to use it to your advantage.
And one more thing I'd like to say about Allison, she's a fantastic marketer because I looked at her video, and she has these good-looking young guys riding these giant waves. So it's an interesting podcast. I mean, I don't know what you call those things anymore. But you can go to her website, AllisonSchrager.com. Even if you're not interested in risk, her video is, at minimum, entertaining. So, anyway,
Allison, welcome to the show.
Thanks so much for having me.
You're a very good marketer, I must admit. Very good, very good.
So I take no credit for that. I think that was the Reason video, and they had all the great footage.
It worked. So
your title is a great title because economists and brothels don't necessarily go hand in hand. So, anyways,
that's where we went with it because I study economics of retirement. It's not exactly I don't exactly do these sexy things in my work, and it was just I just kept putting me in these sort of places you would never expect, which is how we chose that title.
So what is an economist walks into a brothel? What's it about?
It's about risk taking. So I said my background's in retirement finance, and the central question this is like one of the pure risk problems you'll ever find is how do you move money into the future? And the more risk you take, the more money you can move into the future, although you risk loss. So it's all one big risk problem, and I spent my career as an economist very focused on risk and how to measure it and how to manage it. And it seemed to me, I noticed that people could be so great about managing risk in one aspect of their lives, but not the others. And I just reject the idea that people can't understand risk. It's really popular to say that. So I was thinking, how, especially with the retirement issue, we've put this huge risk problem on everyone that they have to invest in themselves to their retirement. And it seemed important that people understand all these things I've been studying for so many years. And I fully am committed to this idea that people can understand it. They're not something you have to get a PhD in to understand. These are basic concepts that people need to know. They're fundamental to financial literacy, yet we don't really do anything to teach them formally. So people kind of use them in one area but not the other. And so I've also had a background as a journalist, and I figured a good way to communicate these ideas was to do storytelling, was to find interesting examples of people using these concepts in unusual ways that were memorable and engaging and interesting. And it would also be, a fun experience for me to meet them.
Well, that's great because today, Kim and I are hosting a kind of a luncheon for a U.S. congressman, and he's going to be talking about the retirement risk. There's a new video out by PBS called The Retirement Gamble. And one of the reasons that we started the Rich Dad Company was because, I'm sure in 1974 was ERISA, the entire Employee Retirement Income Security Act, which led to the 401k, and all of these criminal activities called stocks, bonds, mutual funds, and ETFs. And it's just ripping people off. So I sit there and go, oh, my God. And now it's coming home to roost because the World War II generation, our parents' generation, they had what's called defined benefit pension plans. And today baby boomers have these things called no pension plans or defined contribution, IRAs, 401ks and things like this. An average person has no idea what the difference between a mutual fund and an ETF, a stock, or a bond is. And so that's why 22 years ago, we kind of put two words together called financial literacy. And now I'm glad to hear that people are actually using the word because it was made up. It didn't exist because our academic system is made up by people who are not risk takers. They're called school teachers. So anyway, I'm going to hear what you have to say about this because I'm very concerned about the growing gap between the rich and everybody else. But also for my fellow baby boomers right now, a lot of them are going to go, as they say in surfer talk, over the falls. They're just going to get hammered when the next crash comes on them. So what did you find out about surfers versus hookers? I mean, that's a very important way to start.
Well, I went searching for wisdom.
I did too.
Yeah. So most of the stories I read about are people who take risk in really smart, interesting ways, and both surfers and sex workers are very smart. Look, they can be very smart risk takers.
Well, you have to be to survive in both industries.
Totally. I mean, we have this image of both of them being fairly reckless. But when you get to know them and talk to them, particularly the people who are successful in their field, anyone who's successful in any field, no matter what it is, no matter how exotic it is a really good risk taker. So,
but you also said something that's interesting is that people take risk in certain areas but don't take risk in others, right?
Totally. As I said, we have this perception that people are risk averse or risk loving, and some people, are more tolerant of risk than others. But I've never met someone who never takes risks. Especially people like to say women never take risks, which I just find offensive. Like women are great risk takers.
Yeah, that's a great point. And I was talking to Sally Krakow. She was on Wall Street, and she says that women are not risk averse. She likes to use the word risk aware. They're more aware of what the risks are, and so when they make decisions, they're more practical decisions, and they understand the risks and the non-risks.
Especially when a guy comes up and says, "Hi, can I buy you a drink?" The risk is on at that moment. Risk on, risk off. It's risk on at that time.
So,
right?
so how does a surfer manage risk? What did you find out there?
I went to the North Shore of Oahu because they have an annual risk conference.
Oh.
So these are the big wave surfers, opposed to the regular wave surfers, because big wave surfing is exceptionally dangerous. And the waves are like 80
Yeah,
feet
my best friend died outside at sunset.
Oh, I'm sorry.
It kind of ended my big wave surfing career. I mean, he was gone.
It's very dangerous.
Yeah.
I mean, you're in incredibly dangerous conditions. And because people were dying more, they really decided, there was this guy, I don't know if you ever ran across him, named Brian Keolana, and he decided that
Buffalo.
his son.
Yeah, right.
He comes from this long, big wave surfing dynasty. And he was telling me how one day he was, I think he was participating in the Eddy, which is a big wave surfing contest, and he was a lifeguard. So is Buffalo. It's a long history of.
That was Eddie Aikau. He died also.
Yeah.
Yeah.
Exactly. So he was in the water after being wiped out, and he was reflecting. I think it was a couple of days before, there was a surfer who he couldn't rescue and who died, and this was haunting him. And he was now in similar waters. He was a very good swimmer, so he was raised in the water, so he wasn't worried about himself, but he was in the water, sort of bobbling along, waiting for a chance to swim to shore, when a friend of his came by on a stand-up jet ski. They were fairly new, and he said a light went on that, wow, we could use this tool to reduce risk. So once he got home, he bought a Yamaha Wave Runner, and he brought jet skis to big wave surfing. Now, but the thing is, the surfing world is haunted by this issue, which is, you bring a technology to make surfing safer. So with jet skis, it's that you can get rescued when you're wiped out.
And what happened is they went after bigger waves.
Exactly. It's like a stock option.
Yep.
It's like it can be used as insurance, or it can be used as leverage. And so, Brian's concerned about this is like, I'm empowering people to take bigger risks. Not only do they feel safer because they have something that can rescue them, but they also have something that can embolden them to take bigger risks and can push them on bigger waves. So they have an annual conference to discuss risk management. The same way we would in a pension conference, talk about techniques of how to reduce risk and how to take more risk while at the same time ensuring against your downside.
Well, I'm glad to hear that. What do you find out about retirement risk? I mean, in my opinion, nobody's really talking about it right now, but it's going to be one of the biggest disasters, and that disaster went back to '74 when Congress passed ERISA, which led to the 401k, and now you have a whole generations of Americans, about 60%, my generation, will not ever be able to retire. What does your system say about that? Because that's more than the Rich Dad Strike Zone. That's why Rich Dad was formed, really.
Yeah, well, I mean, 401ks, like a defined contribution pension, isn't in and of itself a bad thing. I mean, there's problems with defined benefit plans too. The problem with defined contribution plans is we sort of stuck everyone with this tool without any training, without good investment options, without any financial education. Like saving for retirement, I've spent my whole career on it. I did a PhD in it. I worked with Nobel laureates on it. It's a really hard problem.
Allison, but the biggest problem was they stuck people who are risk averse with it.
And ignorant, and financially ignorant.
Exactly. So we stuck people with an incredibly hard problem that I even struggle with, and they have no tools or education on how to manage it.
I love you, Alice, and I'm glad you're saying that, because that's the reason the Rich Dad Company was formed. I mean, we have a disaster coming, I'm of the generation, that 401k and these IRAs and Roth IRAs and mutual funds and ETFs, I look at them and I'm going, holy mackerel, they're going into the riskiest of all waters today.
So how do you manage that risk? How do you manage the retirement risk? How do you manage the financial risk?
Well, we have to reframe the problem. I mean, there's so many levels of where things have gone wrong, and the least of to start with is we pushed everyone into a 401k without really defined benefit plans had a very clear objective, right? You work for someone and they gave you a secure income.
Yeah, but the difference is, Alice, for those who do not know, a defined benefit plan was technically, which wasn't always true, was professionally managed. Whereas you had somebody who knew.
They often didn't do a very good job.
Yeah, I know most of them were horrible, but anyway, there was some degree in the corporation. If you work for Ford Motor Company, you had a defined benefit. You got a paycheck for the rest of your life. So it was Ford who was managing that fund manager. But now
they took on all the risks for you.
And so that's why
now,
that's why 74 was such a big year for me. I went, holy mackerel, we've screwed a whole generation, and the bill is coming due today.
Yeah, although a lot of people didn't have defined benefit plans, a lot more people can. I mean, defined contribution plans are a lot cheaper for companies to offer because they don't have to take on all this risk because they're cheaper.
Because they don't have to pay for the employee for the rest of their lives.
Well, what ERISA did is not only did it create the 401k, it made companies properly account for how expensive defined benefit plans were because they were being managed a lot more recklessly before. So ERISA forced companies to realize how expensive these promises were. And once they saw that, they're like, we want out of this.
Not only that, when the corporate raiders found the defined benefit plan that was full of money, they went in and raided the company just for that pension plan. And the same thing is going on in Wall Street today. So that's why the Rich Dad Company was formed. We have a bunch of very ignorant people leading ignorant people. That's why I'm glad to hear what you have to say about this whole thing on risk, because it is sold to people who are risk averse, and they don't know what risk is. They don't know, they may take risk in other parts of their lives, but they don't know anything about money or investing or risk. So when we come back, we'll be talking more to Allison Schrager. She's the author of the book An Economist Walks Into a Brothel. It's about risk and risk management, and two very dangerous professions, surfing and hookers. But when we come back, we'll talk about the next subject called hookers. We're right back.
Can I add something to that? So when we come back, I want to talk to Allison about how you take risk and manage risk in business, how you manage risk in money, and what are some of the key points that Allison has discovered in her research.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
What is your number one expense in life? Your number one expense. It's taxes. And I've asked the question is, how come there's no financial education in school, but why isn't there education on taxes either? They tell you to save money, which is stupid. They tell you to invest in the stock market, which is stupid. But what they teach you about taxes? So here we have Rich Dad advisor Tom Wheelwright. We're talking about his revision for his book, Tax-Free Wealth. Welcome, Tom.
Thanks, Robert.
So what's the tax-free wealth about? What's different this time? It's a revised edition.
Well, so what we did was this is the first major tax reform we've had in 30 years, 2017.
Was 86 was the last one?
86 was the last one, back when I was in Washington, D.C.
So many guys got wiped out because of that tax change.
They did. They did. It wiped out an entire industry, savings and loans. This new tax law is just as big, but in a very different way. It affects different industries. The tax law is always a series of incentives. And the question is always which incentives and which ones apply to me. And so the key to revising tax-free wealth was, what changed so much in this new tax law that we can absolutely take advantage of? Seriously, the amazing incentives. For example, the bonus depreciation, for example, for real estate is unbelievable. You buy a $1 million apartment, get a $300,000 deduction or more the very first year.
So if you want to make more money and pay less taxes like Donald Trump and myself, get Tom's book, Tax-Free Wealth.
Financial freedom begins with financial education. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. And today we're talking about a very important subject, especially when it comes to the subject of money. It has to do with risk. And most people are so risk averse, they stay poor, absolutely poor, because our school system, as you know, teaches us zero about money. And on top of that, we're led by a lot of financial planners, stockbrokers, real estate brokers who are more broke than you are. So once again, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android. And all of our programs are archived at richdadradio.com. We archive them because one of the essentials of education is repetition. If you listen to this program one more time or two more times, you'll get smarter because, it's like a golf. When you play golf, the more you swing that club, hopefully the smarter you get. The biggest part about listening to this program, again, is get together with friends, family, and especially business partners. Listen to this program and discuss it because our guest today is Allison Schrager. She is an economist, and she's a founder of Life Cycle Finance Partners, LLC, a risk advisory firm, the author of great book, An Economist Walks Into a Brothel. Please get it. If nothing else, watch the video. It's fantastic. And it's about surfers and hookers. And her website is AllisonSchrager.com. So if you listen to this program one more time, you might learn something about a very important subject called risk. And we all take risk, but in different ways. And so one of the things that Allison and I were discussing at the break is everybody says investing is risky. That's absolutely not true. There are ways you can mitigate risk down to zero, but you have to have the right advisor and the right, professional
education
support here.
And the great experience. Yep.
So, Kim, are we hundreds of thousands and millions in debt?
We are. We
Yeah.
are, but that comes from education, that comes from experience, that
Right.
comes from knowledge.
And Dave Ramsey, who's a good friend, he's got great advice. He says live debt free, and for most
And
people,
for most
that's good
people, that's very good advice.
because they really should not be taking a risk with debt. So Allison again is an economist, and her book is An Economist Walks Into a Brothel, and she discussed surfers and hookers, and she was talking about how they take risk and how they manage risk.
So many of our listeners, they're small business owners, they're small investors. So what would you say to them, some of the keys on how to manage risk as a small business owner or as an investor?
Well, in finance, or the techniques people use is they diversify. So that gets rid of unnecessary risk. And the other things you can do is
That's what
just
financial
stabilize.
planners tell you, right? Diversify. Anyway.
Yeah. Although that will help you get rid of the risk that a single stock will rise or fall, or if you're a business owner and or if you have a store and you only are selling one product,
Right.
you're completely banking on that product
So,
as well.
so
But if you sell
diversification is one way a person can minimize or mitigate their risk.
well, certain kinds of risk, but
Right,
there's still these huge risks, like the risk that there's going to be a recession, or that every single stock's going to fall like it did in 2008, or almost every single stock. So you still have those risks remaining. You also have to think about managing. Or as I said, if you're a small business owner, you're very sensitive to what happens in the whole economy. And that's where you get into the more risk management, which could be hedging, which is just, hedging your bets, taking a little less risk.
Hedge is another word for insurance for people.
Well, I define it a little differently, that where hedging is balancing risk and reward, and insurance is a different concept, which is when you pay someone to take on downside risk for you, or you have a plan.
Allison, I understand the term. I understand the term.
Uh-huh. Okay. Mm-hmm.
So a hedge is, I agree with you 100%, okay? But this is what I do for a living.
So are you saying that a lot of the risk management is that you're kind of looking at all the what-if scenarios and what if the downside scenarios? So like recession, we have to prepare for if there is a recession, how are we prepared to handle that? If interest rates,
how about you lose
if
your job?
inflation, if you lose your job as an individual, how do you hedge for that? How do you mitigate that risk? Is that what you're saying?
Yeah, and it's a very dangerous risk too, because if it's a recession, you're likely to lose money in the stock market and your job at the same time.
And
Right.
your house, and then you're stuck with the
Exactly.
debt.
Exactly.
And
That's
how
why
about student loan debt, which is the worst of all type of debt?
Yeah, well, this is why systematic risk is so dangerous, is because everything seems to go wrong at once, and it's really hard to find any way to diversify your way out of that.
Yeah, you're speaking my language here, Allison. Big question here is today there's a rise of socialism, with AOC and I don't know the rest of those characters. The presidential campaign is now a Jerry Springer show as far as I'm concerned, led by my friend Donald Trump. But I mean, is the rise of socialism because people are afraid of risk?
Well, yeah, I think that's part of it. I think people sense more acute risk, certainly with all the changes that are happening, that there's this more existential threat to their livelihood. And one thing I think with socialism or populism in general is it's saying someone will take care of the risk for you. The government will take care of risk for you.
Right,
And you know that's attractive.
And Allison, the way I always said, capitalism is you teach people to make their money, and then in socialism you give people money, and that's why people want the government to take care of them. That's why they want free education, free health care, free all this other free education, because they really are so risk averse right now.
Well, you know, there's a lot of risks, especially say when the economy is going through a big transition, is that you feel that systematic risk so much more, and it's particularly scary.
Right. So how else does a person mitigate their risk or reduce their risk?
Well, as I said, it could be, as I said, finding different ways to insure. It could be finding different ways to hedge. As I said, figuring out how much risk is right for you. Like I say, you guys feel comfortable taking on debt because you know how to manage that. That's not right for everyone. For other people, it would be getting rid of debt because, you know, if the economy tanks and you still have to make a mortgage payment, that's a riskier situation to be in.
Right. So in your book, an economist walks into a brothel. How do brothel or sex workers manage risk?
Well, you pay, like anything, you pay. You know, there's a cost to reducing risk. So I went to the brothels in Nevada to understand sex work is a very risky job traditionally. You know, you're walking the streets or you're meeting men online, and, you know, they can be violent, they can be police. So the women in Nevada, what they do is they work out of the brothels and they give up 50% of their earnings. They give it to the brothel, and in exchange, the brothel promises them complete safety. And the customers as well are paying for safety because they don't have to worry about a Robert Kraft, Elliot Spitzer type situation. They know that everything is secure. They know the women are tested for diseases, and there really won't be any repercussions. But they also pay a lot more than they would pay an illegal sex worker for that reassurance.
That's good to hear. So how does that translate to the average person's, you know, either a small business or they're an old guy preparing for retirement? How does that translate to them?
Because it sounds like from the sex workers, these are the things that could go wrong. So I think a lot of business owners, they get very optimistic and they get very starry-eyed, and they don't look at what are the downside risks that need to be managed.
I mean, I met a lot of women in the brothel who had worked in the illegal market and had a lot of really scary experiences, which is why they ended up there, because they were very aware of all the downsides from not being out there. So what is it? This is a way of risk reduction, is thinking I will pay in exchange. I will get less money, but I will have less risk.
The
like
other
insurance.
thing here is this: how does a person today, let's say they're an old guy like me, 65 years old, and we're cruising for one of the biggest market crashes in history because of the quantitative easing. They printed so much money. The stock market is at overinflated rates, and all the financial experts are saying stay in the stock market, stay for the long term. And we all know it's going to crash because markets crash about every 10 years, so we're overdue right now. How does a person with a 401k or an IRA protect themselves from a catastrophic market crash?
Well, it depends on where you are as an investor. I mean, certain assets are less volatile, so you could invest more in bonds. I mean, it's a lower return, but you do face less risk. Or if you are investing more for the long term and you've got a stable job and stable earnings, you just have to ride it out and be like, all right, the market's going to crash, but I know, or I hope it will come back. So you have to balance those two things. One, your investment horizon, and two, how much risk you feel comfortable taking, and get into lower volatility of the lower earning assets to compensate.
So you have the standard financial planner pitch on how to mitigate risk.
I guess so.
Yeah. So let me say, as a surfer, when you're paddling out, and you say waves come in sets of 5, generally they're 3 to 5, and you see this huge wave about to crash on you, and you're halfway out, which is where I'd say most people are today. What would you do today?
Well, listen, you have to decide, what's right for you and your risk tolerance. I mean, a lot of the surfers I met, would let that wave go and go for a later wave in the set, even if it would be smaller. Because if you take that first big wave and it crashes on you, you might be dead. So, you balance, do I want that career-defining huge wave, or do I want to take maybe a wave that's maybe, 2/3 of the size, but I know I'll be safer? And a lot of them make that decision. I think we like to think these guys as daredevils, but I found a lot of them made the decision to wait for the later wave.
Now, I like what you said about in your book, An Economist Walks Into a Brothel, that these big wave surfers are very smart people. They understand risk.
Oh, yeah.
And the reason I'm encouraging people to get your book, An Economist Walks Into a Brothel, is in today's world of high risk, you have to look in the mirror. Who are you? If you're not a big wave surfer, you shouldn't be out there. And if you're not a hooker, you shouldn't be there either. But most people don't look in the mirror, and then they take advice from people like school teachers or financial planners who are also risk averse. And they don't get educated. Any comments on that,
Well,
Jim?
it's actually why I love the game of golf. I'm a golfer. And every day, every round of golf, every shot almost, you're managing risk. And so you hit a bad shot, and then you've got to figure out, okay, what's the best way to get the best score, the lowest score possible? Here I am under the trees, in the bushes. How am I going to get out of this? And you've got to manage every shot. And I relate that to life. So in business, all of a sudden something goes awry, and you've got to figure out, how am I going to get back on track? How do I make the most money? How do I get my most revenues? So it's like every single day people are managing risk, I think, really not even realizing they're doing it.
Yeah, and if you saw the Masters with Tiger Woods on the hole 12, Tiger took the less risk, and he won because he took the less risk.
Yeah.
And his two guys who were tied with him took the greater risk. But that's kind of human nature, isn't it, Allison? I mean, it's up to the golfer or the person.
Yeah, I mean, you have to know when it's the right. I mean, this is the tricky thing about risk, is knowing when is what risks are the right ones to take, and when is it better to hedge, or how much to hedge. This is what makes it hard.
Yeah, and what happened when my best friend, his name was Carl Rohner, when he died, surfing. A lot of us stopped surfing. It was so tragic. You see your friend get wiped out, and they never found his body. So, that's why I love your book. I love what you're talking about here, is that the risk is up to you to manage. But I think you have to look in the mirror personally, don't you, as an individual?
Totally. I mean, this is one of the big issues at the surf conference, is how many people are out there surfing big waves who don't belong out there. But to be honest, a lot of the sort of tragic accidents in surfing have been skilled people. Even if you do know what you're doing, sometimes things happen that you can't control.
Yeah. We often say that, investing isn't risky, but it's the investor that's risky. And that's the uneducated, ignorant person that's taking these risks with no background, no education, and don't really know what they're doing. That's very risky.
Totally.
And then what you said about technology was, it's very, very insightful, Allison. When they came out with those wave runners and all this, they started a new type of surfing called towing. And what they could go further out into the sea, and they could find these ocean waves, and then they would hook the surfer up to it, and they would tow him into position, so the surfer could pick up enough speed to catch an ocean wave, not a shore wave. And so what happened with technology and surfing was these surfers kept going for bigger and bigger waves. And that's why I'm concerned about this economy today with technology, called algorithm they have for investing. They've taken technology and taken bigger and bigger risk, which is why I'm concerned about the future of all these baby boomers paddling around with a little defined contribution 401ks and IRAs. Because these guys who are running the biggest hedge funds in the world, they're actually tow-in surfers. They're doing those. They can take faster risk, and they're trading now. When you say invest for the long term, these guys are trading within half a second, and taking bigger risks with bigger bets. And the average guy is sitting there with a little 401k, knowing these guys who are tow-in surfers are about to bring down the world economy. What do you think about that?
Yeah. I think that's mostly right, because that is what most hedge funds are doing, is they make bigger returns than everyone else by taking leverage, which is...
Leverage is more money for smaller return.
Yeah, so what you borrow against your returns, and that is more risky, but it also can amplify your returns. And that's a lot like a similar function that jet skis play in surfing, which is, Sid, a lot of them, or what they're doing is they're using options, which are technically insurance, and flipping them around to take leverage, which exists.
And I agree with doing that, but you got to practice doing that. I mean, that is really high risk stuff you're playing with. So,
or more importantly, like what the surfers are discussing, is what about when those risks pose costs to others?
Yep.
Like, if you want to run a hedge fund and blow up your hedge fund, good for you. But if you are posing a systemic risk to other people, then where does the responsibility lie?
And that's what happened in 2008 was the government bailed out those guys who brought down the economy.
Some of them, yeah.
That's what's happening today.
Yeah, and I mean with the surfers as well, they discuss, when you get rescued,
right.
And you're posing a risk to others, where does responsibility lie?
Right. So Allison, thank you very much. I'm really glad we've interviewed you. I love the title of your book, An Economist Walks into a Brothel. I love the two metaphors you use, surfing, big wave surfing especially.
And we didn't even get into all the military examples that you used as well. There's a lot of different examples you use other than brothels and surfers, but that was great.
Yeah, I flew for the Marine Corps, and we practiced before we went to Vietnam. So we knew there was risk, but we had more skill to handle risk. And that's my concern for the average person right now. We're cruising into one of the biggest crashes in history, and they don't know what's going to hit them. So anyway, thank you for your work, Allison.
Thank you, Allison. Her website is Allison Schrager, SCHRAGER, AllisonSchrager.com. Go visit her website, and I'm sure there's a lot of great information on that.
So thank you again, Allison.
Thank you, Allison.
Thank you.
And when we come back, we're going to the most popular part of our program, which is called Ask Robert.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Log on to richdadradio.com while you listen. Now back to Robert Kiyosaki.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show, the good news and bad news about money. Again, I want to thank Allison Schrager because she's talking about her new book, An Economist Walks into a Brothel, 2019. She's a co-founder of Life Cycle Finance Partners, LLC, a risk advisory firm. I think that's interesting. Any comments there, Kim, on Allison?
No, I think it's interesting because there's certainly in the interview and in our discussion with her, there were points that we disagreed on or not necessarily were so aligned on. For example, she said you have to take risks to make money. Okay,
yeah, that's the
and
biggest
that's
lie
a different.
there is.
We have a different point of view here at Rich Dad about that.
Yeah. Anyway, so it's completely opposite. And it's why this Rich Dad, what the rich teach their kids about money, that Wall Street doesn't. Wall Street does the education today. And be careful. My new book is out. It's called Fake Money, Fake Teachers, Fake Assets. Wall Street sells fake assets. They're called stocks, bonds, mutual funds, ETFs, and savings. That's who sells you those asset classes. They're fake assets. Like your house is not an asset. I said that in Rich Dad, Poor Dad. So we're a financial education company. I'm not a stockbroker. I'm not a real estate broker. But we are educators. We want to point out the differences.
So our philosophy at Rich Dad is that you don't necessarily have to take risks to make money. Where the risk gets reduced is through education, through experience, through doing the real thing.
Amen.
And
amen.
you do that,
amen.
There's less risk.
And you be careful in fake money, fake teachers, and fake assets. Most people listen to fake teachers. They're called financial planners, stockbrokers, real estate brokers, insurance planners. All these guys, they're just trying to sell you something. Look, there doesn't have to be risk. And I like Allison's book, An Economist Walks into a Brothel, because I was a big wave surfer until one of my best friends, Carl Rohner. He was killed out there. They never found his body. That is a very dangerous business. As far as the whorehouses go, I said I did call Kim from one, but everything my mother said not to do became my to-do list before I got married. So anyway, I've done a lot of the things there. And what she's absolutely true is the higher the risk of the industry, the smarter you've got to be.
Yeah, I mean, she made a very good point. You got to look at what are the risks, and in her example of the sex workers, they mitigated the risk by paying a higher percentage of what they collected in return for safety.
For protection.
I mean, that's protection. That makes perfect sense. And that's, if you look at her book, there's a lot of different examples on how to mitigate risk, how to manage risk. And for a business owner, I think, and an investor, I think it's a great book.
Yeah, I mean, it really is, because we had General McChrystal on. He was 4-star general. He got fired by Obama, which I think was interesting. But McChrystal said, because he's West Point, I'm with Kings Point, we're military guys. He says, the biggest risk is the person looking at you in the mirror. He says, when you look at what is risk, you got to look at yourself. And I think that's what people don't tell people, is that who is risky? The stock, the bond, the real estate, the asset, the gold, the silver, or are you the risky person? You know, it's not the asset, it's you. It's the guy looking, or the woman looking in the mirror. Or did you marry some idiot who you think is going to protect you? Or do you have a job you think is going to protect you? You're the person that's at risk because you're the risky person. And that's the Rich Dad philosophy. So our philosophy is, get financially educated. My new book is Fake. We have cash flow gains. We have Rich Dad, Poor Dad. We have cash flow quadrant. It's all about who do you have to be when you look in that mirror. And most people are idiots. They have no financial education, and they take advice from people with no financial education either. They take from fake teachers. Like I talk about in Fake. I went to Vietnam. My teachers were real pilots. When I was in school, most teachers were fake teachers. They had no idea what they were talking about. There's a guy teaching me calculus, 3rd year of calculus. He never used this stuff. The guy that taught me accounting wasn't an accountant. That's what's happening today. So sports fans, the reason we have the Rich Dad Company here is so you can listen to real people, or we'll debate with them. But be careful who gives you financial advice. If you want to take financial advice from a financial planner, just know most of them are not rich people. Most of them are risk averse. So you can submit your questions to Ask Robert at richdadradio.com. And so, Tony, what's the first question for Ask Robert?
First question comes from Chelsea in Tempe, Arizona. Robert and Kim, how has your tolerance for risk-taking changed as you've become more successful?
That's a great question. Yeah. Look, what every financial planner will tell you is that you have to take risk to make money. That is an out-and-out lie. See, the more financial education you have, the less risk you take, and the more money you make. Let's take a crash. Kim, when the markets crashed 2005, 6, and 7, did we make money or did we lose money?
We made a lot of money.
We made fortunes. Most people make fortunes when markets crash. The metaphor of the big wave surfer, that's God to us. I'm waiting. This next crash is coming. It's pretty close. And unfortunately, the reason we started this Rich Dad Company is millions, probably billions of my generation, baby boomers and millennials will get wiped out because they have no financial education in school. So the risk is listening to idiots who have no financial education and want to sell you something. It's called Wall Street. Think about it this way. When Wall Street crashed, they brought the crash. The government bailed them out. Did they bail you out? No. And that's the game plan, sports fans. So that's my new book, Fake Money, Fake Teachers, Fake Assets. Be careful who you take financial advice from. Any comments, Jim?
Yeah, well, when you hear about risk, so most people think borrowing money is risky or investing your money is risky. And to Chelsea's point, we do bigger and bigger deals. We borrow more and more money because we have our experience. We've made a lot of mistakes. We've had successes. We're out there. We increase our knowledge with every single investment we do. So we can do the bigger deals and borrow more money and invest more money because of our education.
Yeah. So let me give you one more piece of information. Diversification. Every financial plan will give you that same rot, diversify, reduce risk. That is a bunch of BS, blue sky. It's not diversify, it's de-worsify. You're not reducing your risk at all. Let me give you an example. From Rich Dad, Poor Dad and all the other books, there's 4 basic asset classes. There's business, the highest risk of all things. Yet people say, I'm going to start my business. They have no experience. They can't sell. They don't know taxes. They don't have a team. The second highest risk is real estate. And most people, we had a friend who said, yeah, I'm a real estate investor. I bought 6 houses that they lived in. That's not investing. That's consumption. But they think they're real estate investors. They think they're Donald Trump. The third asset class is paper assets, stocks, bonds, mutual funds, ETFs, and savings. That's what Wall Street and the bank pump out. And the fourth asset class are commodities. Gold, silver, real estate, food, real commodities. Now, when Wall Street says to you, or people like Allison say to you, diversify, they're talking to you about diversifying, which means you go into the third category called paper assets, stocks, bonds, mutual funds, ETFs. Well, they say, put 60% of your money in equities when you're young and 40% in bonds. And when you get older, put 60% in bonds and 40% in equity, stocks. You haven't diversified. You're still in paper assets, the riskiest of all assets. And the only people that make money on it is Wall Street. Smell the roses, man. These guys are the ones selling this garbage to you. Now, to do what Kim and I do, you have to have financial education, right, Kim?
That's correct.
That's why we have the cash flow game. That's why we've had advisors. We have Ken McElroy on real estate, not these phony flippers.
Well, even on paper assets, you got Andy Tanner, but he's teaching you how to trade with options, which reduces and mitigates your risk.
Yeah, and you make more money when market crashes. So when these financial planners tell you diversify, it's diversify, but you're playing straight into the hands of Wall Street. That's Goldman Sachs, Lehman Brothers, all this, Wells Fargo. These guys are ripping us off. That's why I wrote the book Fake. And they hire these financial planners to go out there and tell you, just diversify. You're not diversified. You're still in one asset class called paper. And when this market crashes down, which it will soon, because after 2008, they pumped trillions of dollars to blow up the stock market and real estate market into a bubble. When that baby comes crashing down, my generation of baby boomers are going to be toast. Maybe most of the millennials and all, they're leaving school with student loan debt. And they don't even know. They think the banks provide student loan debt. The banks don't provide student loan debt. In 2009, a guy named President Obama canceled the student loan program, and the banks got out of the student loan business, and the U.S. Treasury got into it. But they don't tell you that. It was President Obama who set up the current student loan program. And today it is the biggest asset class of the U.S. Treasury. Today, $1.6 trillion. But they don't tell you that on television. So these are the reasons we have the Rich Dad Company. And look, ladies and gentlemen, you've got to be a little bit smarter than that today. Be careful who you take your financial advice from. So with that said, you can submit your questions to Ask Robert at richdadradio.com. I thank Allison again. Her advice is good for the average person. Dave Ramsey's advice is good. Live debt-free if you don't have any financial education, but living debt-free won't help you if you lose your job or the market crashes. So with that, that's why we believe in real financial education. Thank you for listening to the Rich Dad Radio Show.